Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. There's more to real estate than property. Today we'll talk about uncovering financial strategies to unlock your equity, lower your taxes, and increase your cash flow as we wrap up 2021 on the Real Estate Guys radio program.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me in this festive season, it's our co-host financial strategist, Russell Gray.
Hey, Robert.
Today is a day that was earmarked for you, Russ, because we're going to talk about a subject that's near and dear to your heart, and that is the financial strategies involved with leveraging real estate. So 8 or 10 weeks back, we did a show with the amazing Stephanie Riley about mortgages. And obviously, the mortgage is a tool we use as real estate investors to get that leverage. We put down part of the money, the bank puts down most of the money, and we make all of the upside. It's a great deal. Leverage, of course, a two-edged sword. And the show we did with Steph was really all about what it takes to qualify today and thinking through managing your credit score, what your income looks like, and so forth. So if you haven't heard that show, I would say you better go back and hear it. But we did ask the guys a couple of weeks back, and there were several questions, as there always are in our email newsletter grab bag, that are similar to a couple questions we're going to share with you today. And it all falls around financial strategy. Not financing, but that's obviously part of it, but the strategy involved. And so before we get to these specific questions, which I think are great and will give people a lot of food for thought, which is why we picked them, Russ, take us through how you approach real estate, not from a which neighborhood, which demographic, who am I trying to serve, those kinds of things, but really from the strategy that's involved in the financing side.
Well, I know it's sacrilegious for hardcore real estate people like you, Robert, to look at the real estate or the property as a widget. But to me, that's all it is. It's just a vehicle that produces a financial result. That's why I'm interested in it. And so you have to understand that there are components of that structure, the financial structure, not the physical structure, components of the financial structure. You know, you talk about approaching a deal and you're going to put together your capital stack, which is your debt and your equity. And how are you going to structure that? Of course, you're going to manage all of that through the cash flow. And then you're concerned about interest rates and before tax and after tax. And of course, your operating expenses are huge. You have to worry about things like reserves. So even though you're looking at the deal on a standalone basis, it does fit into your portfolio, and you have to think about where it fits on the risk spectrum. Is it going to be something that's going to add exposure, add risk, and you're going to need to beef up your liquidity to be able to deal with that? That's what reserves are all about. Are you heading into an environment where interest rates may rise, and therefore you want to use longer-term financing and lock in the cheap financing of today? Or the reverse, where you think, hey, you know what, interest rates are on a downward trend. I'm going to go with shorter term, and then that way I will get the benefit of lower rates now and the opportunity to benefit from lower rates as they go. There was a time in our career, we've been together long enough, where we were doing that. And I was a big advocate of adjustable rate, maybe 3 to 5 year fixed rates. And over time, as we got closer to the zero bound, I flipped and I started talking about the importance of locking in long term.
Well, and again, that's a great example because back in the day, you did the math and the math told us what to do. I remember looking at several properties about 3 years in and comparing what I had paid on those adjustable rate mortgages compared to what it had been fixed. And it was tens of thousands of dollars in my favor. Now, obviously, if you pick an adjustable rate, well, then you're at market risk of that rate going up. We had several years where the rates actually went down. So now your payment went down. The flip you're talking about came when it made better sense financially and from risk assessment standpoint to lock in a fixed rate because they were relatively low and relatively certain.
Yeah, when they hit historic lows, you have to ask yourself, what's the probability? As George Gammon often says, there's no guarantees, only probabilities.
Right.
And so you have to just weigh the probabilities. And if you're at an all-time low at a rate, you have to ask yourself, what's the probability of it continuing to fall dramatically? Probably not high. Although I would make the argument there's a lot of pressure for rates to fall in the real world, and that's why we see inflation, which is a whole different discussion. But you just have to ask yourself, is it realistic to think that this thing is going to fall dramatically versus the chances it could spike up and surprise me? And am I willing to take that risk? Same thing's true in the stock market. We have the stock market at all-time highs. What's the probability of it continuing to go higher? You can make the argument for a long time, hey, it's pretty good because it's been continuing to do that. On the flip side of it, are you willing to take the risk? If you're not willing to take the risk, or you may want to mitigate, you may want to take a little bit of the profit off the table and put it into something a little bit more conservative. Do you give up the upside if the stock market continues an epic bull run? Yes, but you've bought yourself some peace of mind. So these are portfolio decisions. These are strategic financial decisions that you make that aren't specific to a deal. It's how are you going to deal with your portfolio? Paper asset people, professional financial managers and planners and fund managers that deal in the paper world, they think in terms of portfolio, allocations, exposures, strategies. Real estate people don't tend to think that way. They think about deals and they just stack up deal after deal, and maybe they pick a niche or a philosophy and they just go with it. And you can have a lot of success. But if you end up being a little overweighted or overexposed to a particular risk, like I was personally in 2007, 2008, if the tide turns on you in a way you don't see coming or don't have time to react to, then it can really undermine everything you did. And that's what happened to me. And that's where I really became adamant about the importance of getting this information out there and helping people begin to understand the bigger picture, number one. Number two is you need to think about what you're doing in terms of your overall portfolio. And when you start opening your mind up, you can start playing mix and match. You can look at the property, but you can do other things like bringing in high yield debt to partner with that. You start thinking of ways you can unlock the equity that's in a property because it's basically sitting idle, and find a way to use it more strategically.
And we're going to talk about some of that today, specifically with the questions that have come in. I think at the beginning, the big picture is exactly what you're talking about. Your decisions in terms of the financing are independent of the property. Now, every now and then we buy a unique property that, hey, there comes with financing because the seller's going to carry, or that's still got some financing that I can assume, and those are rare, but they do happen. But in most cases, you're going to figure out the property you want based on your study of the market and what you're expecting and wanting in terms of cash flow versus equity growth and all those things. And then you're going to match it up with a mortgage of some kind. Now, obviously, you can buy property for cash. And people do. In fact, many, many, many properties in the world are bought and paid for completely with cash. There is no financing. The minority of properties in the world are financed. Those of us in real estate think, well, that's crazy. Why would you buy for all cash? Rather than buy one with 100% of my cash, I could buy 5 with 20% down each, right? That's just the way we think. But let's go back to this idea of the real estate being interchangeable. I almost think of it as two things. The real estate is an asset. But the mortgage, although traditionally a liability, can help you afford that asset in such a way that we get the tax benefits, we get the ownership and the upside. Our friend Robert Kiyosaki talks about the reason he likes real estate so much is not for real estate, it's for the debt and the taxes. And so those are things we consider. We're going to set aside taxes for today's discussion. I'm sure that will come up in the new year. But for now, you got to get your head around your personal investment philosophy and how you are looking at debt. If you're brand new to real estate investing, the most common Ask the Guys question we get comes from somebody just starting out. And we have a big heart for those people. So let's take it at the very beginning. We talked a little bit on the show we did on real estate financing about young people getting their credit scores and getting their life on paper to look like they could get to a point to afford a property. Let's not start that early. Let's just say somebody's, thinking about buying a property and they've got to make the decision of the financing involved. Obviously, there's a lot to think about. Things like how long do you expect to have the property? back when we used to do the adjustable mortgages and had a lot of folks doing those, you'd have to really look at that, because an adjustable mortgage might only be good for 3 or 5 or 10 years. If you plan to be in the property for a short period of time, you'd make a different decision than if it was a property you expected to have in your family forever. So take us through some of the strategy involved and the trade-offs when it comes to figuring out how to lever real estate if you're starting out.
Well, I think the first thing you have to ask yourself is, what am I trying to accomplish? So for the people that have a property that's paid for, they're concerned with preservation of wealth. They've taken a chunk of their balance sheet and dedicated it into real property, and they aren't looking to grow it necessarily. They're just looking to preserve it in something that's real. There's a lot of people that do that. And they feel that the debt is a risk, because if they lose control of the debt, they could lose the property and they could lose the equity in the property, which is true. However, if you're not there, or you want to continue to grow, you have to realize that debt is the best equity building tool you can get. And this is the thing people don't understand. I just give you a very, very simple example. So let's imagine at a given interest rate, and I'm going to use approximately 7%, because if you are familiar with the rule of 72, it just kind of tells you how long it would take. If you divide a number by an interest rate, it tells you how long. So in 10 years at 7%, a house would double in price. So if you were to buy a home and it doubled in price, that would be great, but you would have to put in all cash to buy it. If you could use all debt to buy it, and you could buy another one just like it, now you own 2 homes with all debt, and that debt is being serviced by the rental income and the tax breaks that you also purchased when you bought the home, because the tax breaks and the rental income came with the property. If you never paid down a penny of your loan, no loan acceleration, no amortization, in 10 years, if both properties doubled, which is about 7% annual appreciation, then you could sell one property and completely pay off the other one. In other words, you have built wealth. In 10 years, you have a property that you own free and clear, and you never paid down a single penny of debt. And that's, you relied 100% upon inflation to make your debt go away. And when you understand the concept that inflation diminishes the burden of debt, and that the people who control the levers, who decide if we're going to have inflation or not have inflation, are basically trying to relieve the largest debtor in the world, the United States government, of the burden of its debt, now you understand why our system is so full of inflation. So rather than try to fight against that by being a saver, you actually ride the wave by becoming a borrower. Inflation is a wealth transfer from savers to borrowers. I personally think it's evil and unethical, but it's the system that we live in. And so you either have a choice to be victimized by it or profit from it. And my choice is I'm going to go ahead and try to profit from it.
Well, and again, that's part of your strategy in acquiring real estate, an asset that's a hard asset, a real asset controlled by debt. And the debt helps us get into position where we have ongoing cash flow above our expenses and an increase in value over time. Both of those things are good. But the financing piece is critical because it affects a lot as you move along in your real estate investing career and you do things like 1031 exchanges, moving into bigger properties. Debt's going to factor in there. The type of debt is different, and it's not the same on single family homes as it is on 200 units, as it is on a commercial building. But the strategy behind it is still, what do I want debt to do for me? It's going to leverage. It's definitely going to put me in a leverage position, which will increase my equity over time, provided the market does well. And with inflation and so forth in a pretty clear pattern, we're still willing to bet on that. But then the other part is just your comfort level. As soon as you said 2 houses with all leverage, all debt, no equity at all, there were people listening going, ooh, that's risky, right? Ooh, wow, what happens if you get
really,
make the
what
payment?
do you have to lose? Maybe your credit score. That's it, right? If you have no equity in the game, what do you really lose? You lose nothing. And your credit score can actually heal itself.
You understand that. But what I'm saying is, from a human emotional level, I remember you and I were speaking at an event for an apartment association, and we did the example of 50% leverage, so 2 to 1, like really, really conservative. And we said, now who thinks that 50% leverage is crazy wild? And there was a bunch of old guys who put their hands up. And it was a reality check going, man, we love leverage. We want as much as we can get. But these old guys, look at them. They've been in the game a long, long time, and they think that's too much leverage.
Well, when you're in the game a long time, you go back long enough to remember when we operated in what was considered a sound money environment. And in a sound money environment, saving makes sense. Conservative positions make sense. Getting out of debt and staying out of debt makes sense. But in a unsound money environment, in an inflationary environment, it actually, you fall further and further behind. And I did many, many seminars over the years showing the math. It's in our book, Equity Happens. I show the math that actually you slow down your equity growth rate. You slow down your return on investment by allowing the property to accumulate equity. So debt is not just for acquiring a property. It's so much more than that. Debt is how you grow equity and manage equity. And we can talk more about that on the backside, but that's a key component when you really understand what debt is and how to use it in this kind of an environment.
Well, as you were talking, I was thinking, I hope we have time on the show to cover our concept of optimization. So we'll seek to do that. But when we come back, you're going to hear from a couple of listeners who have great questions that I think lots of people can relate to. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from April 1st to 4th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown, and with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong and contracts are in English. And on Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me in April in Ambergris Caye, Belize as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize and the Real Estate Guys for all these years. Now come see what the excitement is all about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize April 1st through 4th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hey everybody, it's Jay Papazan, co-author of The One Thing, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. Hope you're enjoying this fabulous time of year. We thought we'd take today and talk about the financial strategies involved in leveraging real estate. We did our Ask the Guys show a couple weeks back, and you can always reach out and ask the guys if you go to the website at realestateguysradio.com and click the button that says Ask the Guys. And a couple of questions came in, as they always seem to, about financing. And rather than cover them and Ask the Guys, I thought this is almost an entire show. So Ina from San Clemente, California says, hey guys, I'm looking into tapping into my equity for real estate investing. I own 3 homes. I have $1 million in equity in my primary residence, and I have $250,000 of equity in each of my second and third properties. I've been looking into home equity agreements where no payments are due and I'd be giving up some of my equity. That's probably like a reverse mortgage, I'm guessing. What are your thoughts? I've looked at the financials on this, and my interest rate to repay after 10 years would be the equivalent of 8%, but I would not have any loan payments due during this time, and it would not show up as debt on my debt to income ratios. I just started investing in properties in 2020 when I received a large equity payout from my job, and I want to make sure that I leverage my debt options to avoid taxes as much as possible. What are your thoughts on this? P.S. See you next month in Lake Las Vegas. My husband and I will be attending your goals retreat. All right. Well, great question. And even though it's very specific, there's a lot of parts of this that I think people can wrap their mind around. So let's first talk about the equity part. She bought just, a year and a half ago and already has a lot of equity. She got $1 million of equity in one property and $250 in each of her other two properties. And there's probably folks listening that have equity, as Bob Helms would say, lying fallow. You've got equity, and to your point, Russ, your return on your equity decreases as you do nothing about it, and the value goes up. Your leverage ratios are less. So how do you approach this equity and use it as an asset?
Well, I think that the concept is, first of all, you're looking at your balance sheet, and your balance sheet contains equity that isn't working that hard. And you realize that it is idle. It is an idle tool. It's like having an employee that is just not producing. And so you want to try to figure out, how can I put this asset into use so that I can get some profit on it? And so to do that, you're going to use debt. There's only two ways to free the equity. You're either going to borrow against it or you're going to sell it. Now, this equity agreement, it sounds like what you've done is effectively sold the property a little at a time.
Well, and she hasn't done that yet. So that's the next part. Before we get to that, she's looking into those kinds of agreements. But we know right now she's got $1.5 million worth of equity, and she wants to invest in more real estate.
Yeah. So first thing you have to do in looking at a property is deciding, do I want to keep the property? If I didn't already own the property, would I want to own it? Do I feel good about the market? Do I feel good about the future of all the other things available to me? Taking into consideration the friction or the cost of selling and the effort it would take to move or to sell a property and acquire another property. Do I want to keep this property? Assuming that the answer to that question is yes, then the next question is, what is the best way, most effective way for me to harvest that equity or release that equity and put it to work someplace else? And almost always that's going to rely upon a concept called arbitrage. And so what you're going to do is you're going to look at the cost of accessing that debt, and let's just throw a number on it. Let's call it 4%. If you're going to pay 4% annual interest, which is going to be tax deductible, but we're just going to use gross numbers right now, then you're going to have an expense, a cash flow impact in accessing that equity. Now, the question is, can you do something with the equity that will handle the payment so that you're net negative or maybe even net positive? And the short answer is, of course, yes. If you were able to invest that at an 8% yield, then you could take 50% of the proceeds and invest it and cover 100% of the cost of accessing it, and then have the other half of the equity cash, which is not taxable because it's loan proceeds and you're not really realizing a gain. You are just releasing the equity in terms of cash, exchanging a lien against the property for the cash on your balance sheet. So you have more liquid net worth. Now, what can you do with that newly found liquidity on your balance sheet that has no payment attached to it? Well, you could use it as a down payment on another property. We talk about that. We call it the free duplex story. You use equity in property A to make down payment in property B, and then you get a new loan and you purchase the property and the income and the tax breaks. And if you put that all in a blender and it's net cash flow positive, then now you own a new asset and you've created more leverage on your balance sheet, more debt. And as we talked about earlier in the show, the benefit of that is you will be able to see that debt diminish over time as a result of inherent innate inflation that's built into the system. That's the basic principle. Now, what you choose to do with it, that's up to you. We've talked about investing some of it maybe in gold. If you want to be in a more conservative outside the dollar, outside the financial system, you could put it into crypto. If you wanted to be what I would consider to be a little bit more speculative, but still outside the banking system, still outside the dollar. If you could find the right opportunities in real estate, as I just mentioned, you could move into real estate. The other thing you could do is you could just create more income. So if, for example, you borrowed out, let's just call it $100,000 at 4%, you're going to have a $4,000 interest payment. But if you were able to take that $100,000 and invest it at 8%, you're going to have an $8,000 interest income. And so you've created a positive $333 a month or $4,000 a year of income. And you've bolstered your position overall in your balance sheet, not by going out and buying an income producing property, but just by buying debt, being on the other side of the equation. So those are all of the different possibilities. There's a lot more than that, but those are the basics.
Now, she says she wants to buy real estate with it. So that presupposes you can find good markets and all that kind of stuff. And then also, you got to be able to qualify for those loans, which I think speaks to her second point, which is this idea of rather than just getting a loan and paying the low interest rates that are available today, doing a reverse mortgage, pulling the equity out of the property or giving up some of the ownership of the house in exchange for no payments, but in the light of day, paying it back looks like an 8% number instead of we might borrow today at 3 or 4. What are your thoughts there?
Well, I'm not a fan. I've never been a fan. So we've had people on the show that have tried to persuade me otherwise, but I'm still not convinced. So to me, it's just math and in understanding what you're giving up and what you're getting and compared to what. So right now we have long-term fixed interest rates at all-time lows. And to me, the ability to positively arbitrage that and find other things to invest in to easily cover the payment and create positive cash flow, you just have a lot more control and flexibility. So I like that. I'd prefer to do that. And then again, what you choose to do is really going to be up to you. Now, so the sequence would be, first of all, you have to go and get an assessment with a mortgage professional to find out what are you capable of borrowing based on your current profile. If you're within spitting distance of maybe a credit score adjustment or paying off some high payment but low balance debt. For example, a car. If I have a car, I could have a $500 payment remaining on a car loan that I only owe $10,000 or $15,000 on. So for $10,000 or $15,000, I can buy back $500 a month of income, which goes a long way in a mortgage. That would be a good investment. A mortgage professional can help coach you through managing your overall credit profile to get your DTIs, your debt to income ratios down to maximize your ability to access the best debt. That's number one. Number two is going forward, if you're going to accumulate more property and presumably you're going to do it with a down payment and adding more debt, you need to realize what can I qualify for there. If you're going to go with residential 1 to 4, it's going to depend very much on your debt to income ratios. If you have enough equity, and this gal does, then you might be going into an apartment building, a commercial loan where your income ratio really won't matter all that much. What'll matter is the income on the property. And so part of what you're able to do in terms of your borrowing capacity will dictate to a degree what kind of property, what kind of financing you're going to want to look at to partner with the equity that you released from the current properties as down payments into the new properties.
Now, we love buying properties, but there's another thing you could do, and that would be to invest some of that money passively in a real estate private placement or syndication where you would get the cash flow you need and have no responsibility to qualify for the mortgage, both from the risk side and from the qualification side. So lots that you could do there. Now, the last part she talks about is making sure she leverages her debt options to avoid taxes as much as possible. Obviously, we're not tax professionals, but when you do have interest that you're paying on a property, that generally is one of the biggest tax deductions we have as real estate investors.
Yeah, well, I mean, the basic principle is if you borrow money to make an investment, it's a cost of the investment. And so forth, it's deductible against the profit on the investment. And you can talk to your tax professional, but it's not on a deal by deal basis. It's in your portfolio. So if I have debt in my portfolio and I'm using that debt to control assets in my portfolio and I have income in my portfolio, then those passive losses and those interest rate expenses are all deductible against the profits in my portfolio, wherever they come from. And again, I'm not giving tax advice. I recommend you talk to your own CPA, but it's my understanding that's the basic concept. As long as it's business or investment related, it's going to be a deductible expense.
We're talking about financial strategies in your real estate investment portfolio. Speaking about pulling out equity, we'll talk next to a listener who has done that exactly and is now wondering what to do. Plus, we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Are you achieving everything you want in life? What if there was a time-tested way for you to get all you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2022 Goals Retreat, January 7th to 9th in beautiful Lake Las Vegas, Nevada. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at realestateguysradio.com under events, or call 888-489-7723, extension 18 to reserve your spot. Get your life back on track, physically, spiritually, and financially. Attend the live in-person 2022 Goals Retreat on the second weekend of the new year. Click events at realestateguysradio.com to register. This is no dress rehearsal. Live the life you were meant to. Visit realestateguysradio.com or call 888-489-7723, extension 18 today.
Hey everybody, Tom Ziegler here. You're listening to The Real Estate Guys with the one and only Robert Helms. And I got to tell you, this is where you go for wisdom. And as Dad would say, the checkup from the neck up to get rid of the hardening of the attitude so that you can make a difference in the lives of other people.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you want to check out a new and awesome real estate market in 2022, then come join me for the Belize Discovery Trip. Happens the first week of April. It's a ton of fun and you'll learn a lot. All the details at our website at realestateguysradio.com under events, where you'll find the Belize Discovery Trip. We're talking today about financial strategies, and thanks to a couple of listeners that have prompted this show. Before we get back to the discussion, it's time to play real estate trivia. That's your chance to win a prize by knowing today's real estate trivia question. When you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. First person that gets the right answer is going to win an awesome book called Success Habits of Super Achievers. Stories from amazing folks like Les Brown, Brian Tracy, Dennis Waitley, Phil Collin, and more. That can be yours if you know today's real estate trivia question. Last week on the show, we had our good friend Peter Schiff with us, and we asked this: Puerto Rico got its current name back in 1521. What was it called before that? Well, in 1493, Columbus named the island San Juan Bautista after St. John the Baptist. That name lasted until 1521. Here's our real estate trivia question for this week. Since it's winter where we are, here's what we want to know. Where was the coldest temperature on Earth recorded in the last 50 years? I mean, there's some cold places. Maybe you live in one of them, but there's a few places where it is so cold you can barely even stand it. Where was the coldest temperature recorded on Earth in the last 50 years? If you know or just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, the answer to the question, and your physical mailing address, because the first person that gets it right will get the physical copy of this awesome book, Success Habits of Super Achievers. That's today's real estate trivia question. We're devoting the show today to the financial side of real estate, not the part actually about getting loans and the mechanics of that. If you're interested in that and you like this idea of taking money out of your properties, you can get Stephanie Riley's report by sending an email to cashout@realestateguysradio.com, cashout@realestateguysradio.com. But we've got a couple of listeners that have brought scenarios to our attention via Ask the Guys. This one is Paul in Kaysville, Utah. Paul says, hey guys, after refinancing 2 single-family homes this week, we cashed out approximately $150,000. We currently have 8 rental properties with an average of 40% loan to value. so not overly leveraged. No money of our own in any of these deals, and each is cash flowing approximately $400 to $900 per month. What would you do with the cash out money? Should we allocate a percentage to future investments, upgrades, roofs, etc.? Some to savings, precious metals, gifts to the real estate guys. We are looking to purchase more properties and do have some other funds for down payments, etc. And he's got another question which we may or may not be able to get to, but here's an example of a portfolio that has a less than 50% loan to value, has built up obviously some equity and has cash flow. And now Paul's made the decision to pull some of that cash out, just exactly what we were talking about. He's got $150,000 liquid. This is more of a strategy decision now. So Paul, we don't know you well enough to give you any kind of, real advice. But I think, Russ, let's talk through some of the things you'd be thinking about with that type of portfolio and $150,000 cash.
Yeah, absolutely. There's a methodology that you kind of go through. So we always talk about the game of Monopoly as a game to teach you how to invest in real estate. But I'm going to suggest another board game you might want to consider called Risk. And Risk is a world domination, a world war game where you're trying to conquer the world. And what you find out is if you get spread too thin, you get wiped out. And so sometimes you have to retreat and consolidate. And so it's constantly, you're looking at the board, your overall portfolio of territories that you control and how well you control them versus the things that are coming against you, in this case, the other players, and your ability to hold your territory and expand your territory. And that's the essence of the game. Well, one of the things you want to do in any situation when you're trying to decide what to do is you got to look at your portfolio like that board game. And you have to ask yourself through a SWOT analysis, where am I strong? Where am I weak? Where do I have opportunities? And where are the threats coming from? So if you were to look at your situation and say, well, I'm really weak in equity growth, then you're going to direct that money probably towards down payments and pairing it with debt in environments where you feel like you have a good chance for appreciation or forced equity, meaning things you have direct control over. Conversely, you may look at it and say, well, I'm getting killed on taxes. And so you may decide to focus on making a tax advantaged investment and seeking those tax breaks. You may decide that, hey, I'm a little thin on cash flow. $400 or $500 or whatever it is a month, is not bad, but you may decide, hey, I'm a little thin, on those properties. If I have a major event, I'm going to have to come out of pocket. Therefore, I need to bolster my cash flow. And you may decide to invest in high yield debt. You may decide, hey, I'm overly exposed to the dollar, too much savings sitting in cash. I'm liquid, but it's all in the banking system. If we have a banking failure or a currency collapse, I'm in trouble. You might want to purchase precious metals or maybe a portfolio of precious metals and cryptocurrency. So these are the types of things you would be thinking about based on what you are actually looking at when you're looking on your board. Strengths, weaknesses, opportunities, and threats, and how can you strategically deploy that new allocation of soldiers, if you will, to bolster and fortify your situation where you can hold your territory and expand your territory properly. So go back and check out the board game Risk, learn how to play it. I think you'll find it actually helpful in developing your strategic thinking, even in portfolio management.
Now, Paul has an add-on here that I think maybe we'll cover because it expands a little bit on our topic, but it's important to real estate investors. He says also, on a related question, when looking at our net worth, real estate is a much larger position over paper and precious metals. Do you follow or recommend any formulas or guidelines to net worth allocations? Now, we get this question from time to time, like how much should I allocate in each area? And it is a big old whopping, it depends. We're real estate guys, and we're always going to be heavily real estate. I was just having this conversation with Kenny McElroy that the majority of our individual portfolios are so exposed to real estate. However, not all in the same market, not all the same product type, not all with the same leverage. So there's ways to diversify within real estate. Traditional financial planners look at allocation of your portfolio based on formulas. I don't know that we have any formulas, but Russ, what do you have in terms of food for thought for someone to figure out how much exposure they should have to various assets?
This is actually a fantastic question. And what happened is after 2008, and I came out of a background in traditional financial services. And so I thought about the world kind of the way paper people do with asset allocations. You do a pie chart and you look at what you're weighted, the old adage about 60-40, 60% stocks, 40% bonds, or maybe you have a cash allocation. You hear Jim Rickards talk about a 10% allocation to gold. I concluded that the concept of percentages isn't really a good way to approach the problem. So I came up with a different way of looking at it. I call it strategic real asset portfolio theory. And I did a video on it quite some time ago. And in that video, what I did was I took what I call rings of risk. And the first thing you want to do is establish a foundation. So again, going back to traditional financial advice, the idea is, the first thing you have to do is you have to establish an emergency fund, right? You have to make sure that you have enough liquidity to get you through difficult times. So it's not an allocation or percentage. You could be 100% cash while you're building that up, or 100% liquid assets. And so I looked at being exposed to counterparty risk in the banking system, currency risk with the dollar, and said, okay, for my liquidity, I want to have precious metals. I want to have cash outside the banking system. I want to have cash inside the banking system, solid banking system. And maybe I want to have some other things that would be easily barterable. So that becomes kind of your base. Once you've got your base established, then you move out the ring of risk and you go to something fairly conservative, maybe very moderately leveraged real estate, maybe real estate that's completely paid for. Other types of investments you would consider to be very conservative that you can control very easily. And they form another layer of a foundation of a solid base. And as you move up, you build more risk. And then you use structures so that you don't break down the firewalls between those rings of risk, right? One of the key things any real estate investor has to be cognizant of is a personal guarantee. You may go out there and do something way out on the edge, like a real estate development in an unproven market, and sign a personal guarantee on a construction loan that puts your entire balance sheet at risk at the highest area of risk in your activity. So part of it is not just a percentage allocation, it's how you are structured. We spent a lot of time working with our good friend, attorney Kevin Day, developing structures so that you can go take those kind of risks, even sign those personal guarantees, and yet not endanger the vast majority of your wealth. And so those are things you want to take a look at. So I don't have like a ready report, but I do think that based on the show, we'd like to get some information out. So if you'll simply send an email to feedback@realestateguysradio.com, and in the message say that you're interested in the introduction to strategic real asset investing and information on entity structuring for asset protection purposes, for portfolio protection. Doesn't have to be exactly those words. I know those were a lot of words, but just put something in there to that effect. And our team will make sure that we get you information on those two topics because they really go together. And maybe I'll even end up doing some type of a Q&A, a live Q&A webinar or something for everybody if we get enough interest on it. Because I do think it's a hot topic. And I think risk management, risk mitigation is really important right now because we are in a very extreme environment and there are all kinds of risks out there, financial system risks, currency risks, asset bubble risks. There's all kinds of risks that are really a lot higher than I've seen them maybe in my entire career. And I think that there's a lot of things people need to be thinking about. We've got all that wonderful equity on our balance sheet, thanks to the last 10 years of the Fed pumping billions and trillions of dollars into the market. And yet the market giveth and the market taketh away. So this is an opportunity to harvest, protect, and reallocate some of that. But you got to have a system. I'm not big into percentages. I'm more into this other portfolio theory that I've discussed.
Well, and I'll add something to that. And this is every investor's different. And I would always make the argument that if there's an investment that you're well versed in, experienced in, have good relationships and rapport with, that should probably be weighted personally higher for you than something you don't have exposure to. If you're hearing all this talk about crypto and thinking, man, I should get into crypto, you probably shouldn't take half your net worth and dump it into crypto this week. But you should start paying attention if you're interested.
Take a percentage and invest in your education.
Oh, for sure. I mean,
and your network, right? If you get in the right room, you're going to meet people. You can start by reading books, then going to seminars where the people who wrote those books are speaking, and then meet people and the people who are in that space. And that's probably a good investment.
Yeah, an investment in your education always pays the highest dividends. The other thing I'll say is when you talk about allocation of a portfolio, part of that is risk, which I think is where your mind jumped to, Russ. Like, okay, so I got to, in addition to diversifying for risk's sake, I also want to make sure I have asset protection strategies and the right entities and so forth. But the other part of allocation is just exposure to the market. we always talk about there being a certain percentage of your assets that you would be higher risk, higher reward, kind of that speculative part, and then a certain portion that are more conservative, not just because of risk, but because of total gain. So excellent question, Paul. We come back, we're going to talk about how do you optimize your position and not maximize it. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hey everybody, it's Ken McElroy and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you ever wanted to do bigger deals using other people's money, or you want to passively invest with some awesome folks, come on out to the Secrets of Successful Syndication. It's our 2-day class on putting together big deals. It's a lot of fun. It happens in early March 2022. All the details on our website at realestateguysradio.com. Thanks for tuning in today. We're talking about financial strategies, and appreciate those questions that came in and let us talk about a variety of things. I think let's wrap up, Russ, with this idea of optimization. We cover it in our book, which will one day be reprinted, I hope. But here's the concept. People want to squeeze every last dollar out of every transaction. That's maximizing. But in doing that, you often pick up pennies stepping over dollars, or whatever they say, because there's a bigger picture. We call this optimization. And you gave some clues about it earlier, Russ, but take us through how I look at my portfolio to optimize it rather than just maximize it.
Well, it's understanding the impact of leverage. So in very simple terms, if you have a $100,000 property and the market goes up 5%, you make $5,000, right? Your equity grows by $5,000, $100,000 of equity because you have no debt, and $5,000 of new equity because that's how much equity grew on the equity you had invested. That your equity growth rate would be 5%. If you owned that same $100,000 property with a loan and you had $50,000 loan and $50,000 of equity, it would still go up by the same $5,000. But now you would have $5,000 on your $50,000 of equity. And so you would have made 10% equity growth rate because your leverage ratio, 2 parts of property for 1 part of debt versus the equity. So 2 to 1 times 5 is 10%. That's how you do the math. Okay, you take it to the next level. If you go to 4 to 1, you have 25% down on a $100,000 property and $75,000 of loan. You have $25,000 of equity. If that same $100,000 property goes up 5% or $5,000, you have $5,000 on $25,000 invested. And so now you've made 20% because 5 times 4 to 1 leverage is 20%.
And we always say do the math, and the math will tell you what to do. And that always looks great on the chalkboard, and it works. And a lot of our listeners have done really well using that kind of thinking. The optimization part is interesting because your portfolio is an ever-moving process. I'm guessing you already own properties, if you're listening to this show, that have gone up in value in the last 2-3 years. But your mortgage has stayed the same. Therefore, your return on equity has gone down.
That's right. You may have purchased a property that was worth $75,000 and now it's worth $100,000, but you had that $50,000 loan. And so you went from 3-to-1 to 2-to-1. When you sit down and do the math and just understand that impact, so optimization is two parts. One is figuring out what is the most amount of leverage that you can reasonably control with the cash flow, right? Every time you add leverage, you impact the cash flow and you take some risk. So you have to partner those two things together. Maximum leverage would be, well, I'll put no money down on any property and I don't care if I'm negative cash flow, I'll come out of pocket. We played that game for a little while, and you can do that when you're small, and sometimes you may do that in a hot market and it's worth the risk, but you can't play that game at a big level because you can't just continue to add negative cash flow properties to your portfolio. You can't play that game at all in commercial. If you go to the big leagues and you're investing in apartments, you can't do that at all. The bank's not going to play. Nobody's going to loan you money, negative cash flow. They'll do it in the residential space. So there's some advantages to being in small properties early in your career. You can get a lot of leverage. You can get some of the best leverage there is. You can create a lot of equity. You can take some risks that you maybe couldn't afford to take at a bigger scale. But ultimately, you've got to get into the business of knowing how to manage that equity to maintain optimal leverage, which is the highest leverage that you can reasonably control. And when you marry it to some of the things we talked about earlier, where you're using arbitrage, you're using debt, but you're also partnering it with high yield income, meaning that you're both borrowing and lending concurrently, but at a positive spread, then you can put more income into your portfolio to mitigate some of the risks and get some of the equity out of the property and maintain higher leverage. So it's a big topic. We could probably do a whole show on that. Robert, you have a fantastic kind of story that you do that probably doesn't lend itself towards radio, but you talk about your dad's history with that one property. In our book, we call it Bob's Big Boo-Boo, and the difference in optimizing at regular intervals versus just letting a property ride for 25 years is not a small thing. This is a $265,000 property that became a $2.5 million property, but could have become $60 million in equity had that optimization been occurring at regular intervals during the 25-year term of ownership.
Well, I think it's the perfect time of year to end on this note, because we should, at least once a year, look at our portfolios with this kind of eye. Real estate investors tend to set it and forget it. Some stock market investors are watching the screens every single day, and in real estate, there's no reason to do that. But it also leads to lazy landlord syndrome. So our challenge to you would be, take a look at how your properties are leveraged right now, and then just decide, can I do better? Where should I change or improve? Sometimes it's interest rates, sometimes it's not. Sometimes it's optimization. We've enjoyed bringing you lots of awesome guests and shows this year. We've got some incredible stuff lined up for 2022. So tell a friend about the Real Estate Guys. Until next week, Happy New Year. Go make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.